Hello everyone! Today we'll spend 3 minutes understanding what is a margin of safety. It acts like a car's airbag, protecting your principal during market fluctuations. The core idea is simple. Only buying when things are on sale is a good deal, and the same logic applies to stocks. What is a margin of safety? Imagine a stock's true value is $100, but its currently selling for $80 in the market. This gives you a 20 margin of safety, meaning you're buying the asset at a 20 discount. This price difference acts as your risk buffer. How to calculate intrinsic value? Here are 3 practical methods. Discounted cash flow DCF. Assume a company will earn $5.16 million over the next 5 years. Allocated across 1 million shares. Each share is worth $5.16. If the stock price is only 3, the margin of safety is as high as 41.8%. P or E ratio method. If the average P ratio in the industry is 15x, but a company's P or E is only 10x, it may be undervalued. Net asset value method. If the market price falls below the net asset value per share, for example, a stock worth $6 is selling for only $5, there may be a margin of safety. Why is a margin of safety essential? Better risk resilience. If a stock's intrinsic value is 100 per share, buying with a margin of safety at 80 versus buying without it at 100 if both fall by 20%. The former results in smaller losses. Excess returns. When the price rebounds from $80 to $100, you gain not only from the price increase but also from the buffer provided by the margin of safety. Protection against valuation errors. If you misjudge the true value estimating $100 when the actual intrinsic value is 90, buying at 80 with a margin of safety may still yield profits, whereas buying at 100 without it could lead to losses. Practical trading strategies. Buying timing. Conservative investors should wait for a margin of safety of 40% or more, for example, buying at $60 for a $100 intrinsic value, while aggressive investors can enter at 20%, for example, buying at 80. Expand the safety cushion in bear markets and reduce it appropriately in bull markets. Key actions. Regularly update company valuations. Set automatic stop losses. Exit if the price falls 30% below intrinsic value. And diversify investments across 3 or more stocks. Remember 3 rules about margin of safety. Buying cheap is king. Calculating value is the foundation. And patience is the key. Master this tool, and you will stand firm in market volatility.